Okay, so for lesson 1.2, we're going to look at who raises money by selling investments, some of the ways that they can raise that money, and some of the issues that can come up within that investment process. The first business structure that we're going to look at is the sole proprietorship. Oftentimes, when a company first comes into being, it begins as a sole proprietorship with one owner who has sole responsibility for the company. When this structure is used, there's really only one way for the company to raise money, and that is to borrow it. Whether they are going to a government organization to obtain funding of some sort, or whether they're going to a bank to take out a loan or a line of credit. That's really the only way to bring new money in that is not their own into the company. One important piece of information that we have to take into consideration with any sole proprietorship is that a sole proprietorship has unlimited liability, which means that the owner of the company is liable for all of the debts of the business. The business is not a separate entity from the individual owner. They are one. Often the next step for a company that wants to grow beyond a sole proprietorship is to take on partners. When that happens, obviously the business structure changes to a partnership structure. The partners bring money into the company, and in return, they may or may not be given responsibility for the day-to-day decisions in the business. So we can either take on a limited partner or what's called a general partner or an unlimited partner. So if we take on a limited partner, they're providing money and they're getting some of the profit as a result of that, but they don't share in the day-to-day responsibilities of the operations. They also have limited liability with regard to the debts of the business. So they're limited in what they say that they can have in the business, but they also are limited in what they're going to be required to pay in the event of the winding up of the company. If you take on a general partnership, then the partner is providing money on an equal basis or in a proportional basis. They are equally responsible to the original owner as the original owner for the debts in the business, and they share in all aspects of the business, all of the decision making. The third business structure type that we're looking at is that of a corporation. Not all businesses will start out as sole proprietorships or partnerships. Sometimes they will start out immediately as a corporation, even small businesses. There are some benefits to taking on the corporate structure, and there are some negatives or additional requirements to taking on the corporate structure. So one of the biggest benefits of incorporating your business is that it allows you to much more easily raise funds for the growth of the business. Rather than having to take on a partner or go get a loan, you can sell securities to the public, you can sell shares, or you can sell bonds. We'll talk later on about what you're giving up or what you're promising in return for those securities, but it makes it much easier to raise large amounts of money. Going to a bank to take out a $50 million loan would be very difficult, whereas selling securities to the public might be a lot easier to do. In addition to that, when you are a corporation, you have to disclose your financial information to the shareholders. There are different levels of corporations. You have private and public corporations, and there are differences in what they have to disclose. But there are definitely much more or many more reporting requirements for a corporation. The most important benefit to incorporating is that a corporation is a separate entity from its owners. So the owners or the shareholders in a corporation have limited liability. And that means that when I buy a share in a company and I pay $80 for that share, okay, I own a small piece of that company. But when that company goes bankrupt or winds up, I don't have to pay part of that debt. I only stand to lose the $80 that I paid for that share if there's not enough money to give me any money back. So my liability is limited only to what I've invested in the company. All right, so there's quite a bit of information on this slide. This will probably be the largest one in the whole slideshow that we're going to do for this lesson. I guess the way that I'll introduce it is to say that once we have gone into a corporate structure and we're raising money by selling investments to the public, then we're bringing investors in. And that's, I mean, obviously what we're here for. We're talking about investment management and we talk about investments. So investors are extremely important. So on this slide, I'm talking about a number of different things that affect investors, and it's kind of a hodgepodge of information, but we'll go through each one individually. The first one, consumption timing, is pretty easy. Investing would not exist if you didn't have people who had excess money that they didn't need to use right now. So they don't need to use it for consumption right now. And they're going to delay consumption until later. So they're basically saving that money. And in deciding to time their consumption at a later date, they decide to park their money into an investment. So that has to exist in order for investing to exist. Then once an investor has made the decision that, okay, I don't need this money right now, I'm going to invest it for a period of time, they have to determine where they're going to put that money and what investments they're going to buy. So that's where the allocation of risk comes in. Every investment vehicle comes with an element of risk, and the risk being that the value of the investment vehicle will decline at some point in time. So the investor has to determine what the acceptable risk level is to them and what investment product is going to match their risk level. We'll talk a lot about that as we go on. The next two bullet points on the slide have to do not so much with the investors, but with the companies and the structure. So when we're investing in a company, obviously, it's a corporation, and I said before that the corporation is a separate entity from its owners. That can create good and bad things. The good thing is that with a separation of ownership and management, I, as a shareholder in a company, can own 100 shares in that company. And if I decide that I don't want to own those 100 shares anymore, I can sell them easily. I can extract myself from that company, and I'm not a manager. I'm not making decisions in the company, so my leaving doesn't have any impact on the company. So that's a good thing. The agency problem, which is the bullet that I have below separation of ownership and management, is kind of a negative thing that can come up from this separation of ownership and management that exists with a corporation. When I have a sole proprietorship, I'm the owner and I'm also the manager. Therefore, the owner and the manager, who are the same person, want the same things. They always want to do what's right for the company. You would think in a corporation structure that that would also be the case. The CEO is the lead manager, let's say, and you get the CEO and the president and the vice presidents, etc. And they're making the decisions, they're managing the company. And you would think that they want the same thing for the company that the owners do, the shareholders. And by and large, that is true. They want the company to do well. But what can happen is that the managers of the company may make decisions that benefit them in the short run and not benefit the company in the long run. So what I mean by that is, and that's how we get into some of these solutions for the agency problem. So the agency problem is the problem that the owners and the managers might not want the same thing, and there's a conflict of interest there. So in the solutions, I have the first one, compensation, and compensation and options actually kind of go together. Compensation often will be tied to the share price, which sort of makes sense and would sound like it would sort of alleviate this agency problem, because if the CEO is being compensated based on the share price, they're going to want to do whatever they can do to make the share price higher. That's what the shareholders want. Everybody wants the same thing. Everybody's happy, right? Not necessarily, because the CEO may not view themselves as being a lifetime CEO of this company. They may figure they're going to be there for 2 or 3 years and then move on to another company. So what they may do is they may make decisions that will prop up or increase the share price in the short term, which will lead to increased compensation for them. But then they figure they're going to get out before the stock price drops as a result of the long-term implications of that decision. So that's a negative part, and that's really the agency problem. If, however, compensation is tied to stock options, which are different than the options that an investor buys, and we'll talk about those later, but stock options are provided to, say, a CEO or a president, et cetera, that allow them to buy the shares of the company at a reduced price sometime in the future. So if stock options are provided and the future time is significantly far in the future, then the CEO and the managers are making decisions that will impact the stock price positively for a long period of time. The other three things that I have under agency problem or solutions to the agency problem. The third one, BOD, stands for Board of Directors. And that's just basically saying we don't just have a CEO and a president and some VPs making decisions on their own. We also have a board of directors for that company that can be comprised of people from many different industries, and they're from outside of the company itself, and they're tasked with making sure that the decisions that are made by the management, the day-to-day managers of the company, are in the company's best interest. So that's one thing. Third-party analysis refers to equity analysts in the investing market that whose job it is to review the companies on a daily basis. They watch very closely what happens to companies within the industry that they analyze. And they're paying attention to whether they're doing things that are going to be good for the shareholders, because the whole point to their analysis is to advise investors as to whether this company is a good investment or not. So having those third-party analysts looking very closely at what you're doing can help with the agency problem as well, making sure that the management are working really on behalf of the shareholders. And then the last one is the threat of takeover, which is basically if the company isn't being well run, there is a possibility that they will be taken over by another company, and that would affect the CEO negatively, possibly. So that can also impact their decision making. Finally, the last thing that I have on the slide is the recent crises that have occurred within, the last, I guess I say recently, but it's been within the last 15 years or so. We've had, unfortunately, with investing, you're always going to have crises. You're always going to have scandals, because investing revolves around money. And that means that you're always going to have people who are attracted to the investing arena, who value money above all else and are willing to do things that they shouldn't do in order to get more of it. So we're always going to have it, but luckily we have a lot of regulators who are in place to make sure that these things don't happen, or at least to make sure that once they do occur, they're stopped, and we put stopgap measures in place to make sure that they don't continue or that they're not repeated. So Enron is probably the biggest accounting scandal that's happened in recent history. Certainly not the only one, but it was a company that basically they had some questionable accounting practices, shall we say, and they propped up the value of the company on paper so that investors thought the company was worth a lot more. That caused the share price to be high, which was great for a while and was certainly great for the management team until people figured it out, and then the stock prices tanked. Investors lost everything and the company folded. As a result of that, a very large accounting firm also went out of business because they were tasked to audit the books of Enron, and they didn't catch these things, and they should have. So now we have an oversight board, both in Canada and the United States, who oversee what the auditors are doing and ensure that they're working to a higher standard. So there have been some good things that came out of that scandal, although the shareholders certainly wouldn't think so. Then the analyst scandals, what I'm dealing with there is just, I guess, a cautionary tale to investors. We haven't talked a lot yet, or at all yet, about how investment brokers run their business. But basically, if you have a brokerage firm, let's use Merrill Lynch as an example, because they were one of the brokerage firms that were caught up in an analyst scandal several years ago. Merrill Lynch has a retail side, which is where the stockbrokers work, and they have a research side, which is where the analysts work, and they have an underwriting area, which is where a company goes to Merrill Lynch to say, I want to raise $100 million by selling shares, and Merrill Lynch helps them take that to market. So let's say company A is a customer of Merrill Lynch. They've gone to them to raise $100 million in shares. Merrill Lynch is helping them do that. The analysts in the research department are watching company A and they're reporting on it to the brokers in Merrill Lynch to say whether company A is a good investment or not. And they go on for a few years and they keep doing that. And the analysts know that company A is a Merrill Lynch customer, that Merrill Lynch has underwritten their security issues. So they decide that in order to keep that company happy, they're going to always report good news to the brokers, and the brokers will always be recommending to their clients, yes, you should buy company A. It's not the way it should work. The analyst should be reporting accurate information to the brokers so that the brokers can provide accurate information to their clients, regardless of whether company A is a client or not. So it was found out that this was happening, and Merrill Lynch took a very big hit. So those are some of the things that we have to keep in mind with regard to investing. We're going to move on and talk a little bit more now, not about the investing process, but more so about individual investments themselves. All right, so in this slide, I'm talking about the different investments that an investor can purchase, and I've divided them into three categories. I mentioned earlier that the investor has to determine what their risk level is, and then from there they determine what investments would suit their risk level. So this is just the very first attempt, I guess I would say, to kind of get you thinking about the differences in the different types of investments. We're going to go into each of these in much, much, much more detail as other lessons progress. So you certainly won't hear the end of it today. This is just the first little introduction to it, because what we're doing here with this lesson is sort of an overall general introduction to the investment process and the markets. So the three categories that I've got here are fixed income securities, equities, and derivatives. There are other classifications, which I'll talk about as I go along, and it can get a little bit confusing, but as I say, we're going to talk about all of these things in more detail as we go on, so don't worry about it. When you have a fixed income security, first off, these are the lowest risk they tend to be of the different types of investments. They're called fixed income securities because they have a stream of income that is attached to them. That stream of income might be fixed, meaning that it will never change, or it might be floating, meaning that depending on what happens in the economic environment, the income level might go up or down. So fixed income securities can be issued by governments, they can be issued by corporations, they can be issued for short terms, they can be issued for long terms, and all of those things have an impact on the risk level of that investment. So there are all kinds of fixed income securities, and they're not all the same risk level. Each one can have a different risk level. So we have to pay attention to the characteristics of those investments. But in general, this category tends to be the lower risk of the three that are on this slide. When I talk about money market or capital market, that has to do with the timing or the time frame of the investment. If it's a short-term investment that has less than a year to maturity, it's a money market security. Everything else are capital market securities. We'll talk more about that later on as well. Equities, the next asset class that are listed here, would be more risky for lots of different reasons, which again we'll get into later. They don't have an income stream that is guaranteed with them, or as guaranteed as you can get with an investment. They may provide income in the form of dividends. They may not. So equities are shares. Generally, we're talking about common or preferred shares. We'll get into that later as well. But shares denote ownership. So as a shareholder, you own a piece of the company. That means that you share in the fortunes of the company. Usually, if the company does well and they have any funds available, they will distribute those to the shareholders to share the profits with the shareholders. So that will be dividends. They'll distribute those in the form of dividends. They may or may not pay dividends. If a company is focused on growth, they may be earning money, but they may be putting it all back into the company for growth, and they wouldn't be sharing dividends at that point. But other companies that are more established may in fact do that. The value of a share, the share price, really depends on not only how well the company is doing now, but how well the company is anticipated to do in the future. So their earning power. So when we're looking at the valuation of shares, we're always looking at future. What is the company capable of doing? And then finally, we have derivatives, and this is one that can lead to quite a bit of confusion, and have no fear, we're going to talk about it in a lot of detail as we go on. So this is, again, just an introduction. Derivatives are a different class of investments. They may be originated by a company, or they may be originated by individual investors who can write these derivatives. The thing that I want you to know at this point is that a derivative is a more risky investment. So the most risky of the three that are listed on this slide. A derivative is called a derivative because its value is derived from the value of an underlying security. And I know that's really confusing. But if you think about it, let's talk about Company A again. So Company A has common shares that are sold in the market. And when we look online on TMX Money, we see that Company A's shares are $32 a share today. That's the value of the shares. And that value is based on the company's earning power. Now we could have a derivative called a call option based on Company A shares. And the call option's value might be $2. So the investor who owns the call option has the ability to do something with a Company A share. I won't get into it at this point, but they have the ability to do something. And they paid $2 to get that ability. If Company A shares go up in value, then the value of that call option will go up. If Company A shares go down in value, then the value of that call option will go down. So the value of the option is dependent upon the value of the shares. Every change in the value of the shares affects the value of the option. Okay, so when I say its value is derived from the value of an underlying security, that's what I mean. So derivatives don't all move that way. Sometimes when the share price goes up, the derivative's value goes down. There are all sorts of things that can happen. And again, we'll deal with that at a later date. We can use derivatives for speculation, meaning trying to make more money when the value of Company A shares go up or down. Or we can use it for hedging, which means hedging risk. Probably the easiest way to explain that is to say, if I'm a wheat farmer and I know that I have 1 million bushels of wheat that I'm going to be harvesting in 3 months' time, and I'm afraid that the value of wheat is going to go down from today until 3 months from now, I could lock today's price in, and I'm hedging my risk. That means that if I'm right and the price does go down, I've saved myself by locking in today. But I could be wrong, and the price could go up, and then I've foregone the extra money that I could have earned. But I've hedged my risk. I've reduced my risk of that decline in price that I think is going to happen. So derivatives can be used for speculation or for hedging. We will talk about four different types of derivatives: rights, warrants, options, and futures. Forwards are another form of a future, so we'll talk about that later. And whenever we're dealing with derivatives, we're dealing with leverage. When you buy a derivative, remember I talked about the call option and I said its value was $2 and the share value for Company A was $32. there's always that sort of discrepancy. You pay less to buy a derivative than you do to buy the underlying security, but when the price changes, it changes by the same amount, and therefore percentage wise much more. So we'll talk more about that, but that's leverage, is basically investing less, or anytime you borrow, it's called leverage, and you do that in order to gain a larger percentage increase. Okay, so that's financial assets, just some of the different ones that we're going to be dealing with. Again, I don't expect you to know all of that stuff right now. That's just an introduction. This is just a really quick slide just talking about the difference between a primitive security, which would be Company A's stock, and a derivative security, which would be the call option on Company A's stock. So a primitive security's value only depends on the value of the company or the issuer, Company A, and the derivative, the call option, its value depends on the value of the shares that it's written against. So one depends on the financial status of the issuer, the other one depends on the value of the security against which it's written. We've mentioned already that different investments have different risk levels, and I talked just a couple of slides ago about the financial assets, the fixed income, equity, and derivatives. And now I'm going to talk about the asset classes. We have 3 asset classes, and this concept becomes very important because what you will find out is that every investment that we deal with throughout the course of this entire year falls into one of these 3 categories. And each of these categories has a different risk level associated with it and different characteristics. And therefore, what we choose to advise our clients to invest in is usually a percentage in each of these asset classes, but the percentages differ depending on how much risk tolerance that individual has. So we've got 3 asset classes: cash equivalent, which is the lowest risk; income, which is middle of the road with regard to risk; and growth, which is the largest risk. And we'll learn as time goes on which investments fit within each category. This slide is just an overview of what the investment process is for the investor. So we've talked a lot in these slides about risk and the risk level of the individual, and the thing that you will hear me say probably a million times by the time we're done the end of this year is that every investor is an individual, and every individual has different risk tolerance and thoughts and feelings, and you have to take everything in their personal situation into account before you guide them with their investments. So when we look at the consumer investment process, it starts with an assessment of their personal situation, and that's not just their risk tolerance, that's a whole lot of stuff. What is their family makeup? How many people are involved in their family? How do they make decisions in the family? What's most important to them? What are their hopes and dreams for the future? There's a lot of stuff there. We have to make sure next that the family is adequately protected, and that means insurance, because there's no point in investing money if you haven't insured the position that you're in right now. If you're not in a position where you know that if you lost your job tomorrow, you would be okay because you have things in place that'll help you. If you had a fire in your home, you know that there's insurance in place that's going to help to rebuild that house, etc., etc. So insurance is a very important part of the process. And then when we get into the investment recommendations, we look at all of those things: their goals, their risk tolerance. Asset allocation and security selection are very important. Asset allocation refers to those 3 asset classes. How do we allocate 100% of their portfolio amongst those 3 classes? That's if we take you can see at the bottom of the slide, I say portfolio construction is either top down or bottom up. If we take a top-down approach, which often we do, then we make that asset allocation decision first. We decide, okay, this person is really, really not very tolerant of risk, so we're going to put 50% of their money in cash, which is the lowest risk category, and 25% in fixed income, which is middle of the road, and then 25% in growth. So we've made that determination, 50, 25, 25, that's our asset allocation. Once we've decided that, then we can get into selecting securities. All right, I know I have 50% of their $10,000 is going to go into cash, so $5,000 is going to be invested in cash or cash equivalents. Which ones am I going to choose? That's security selection. Do I choose T-bills? Do I choose bankers' acceptances? Do I choose commercial paper? What do I choose? So that's security selection. I go into the growth category, 25% is going in there. Okay, am I going to use common shares? Which common shares am I going to buy? What industries am I going to invest in? That's security selection. So if we go top down, we do asset allocation first, and then we select the securities. But sometimes some investment managers will go bottom up, and they will do the security selection first, feeling that if they've chosen appropriate securities, then the allocation is what it is when we get done. That's, I think, less common. So I've mentioned the word risk a lot of times in this slideshow, and I've talked a lot about the fact that it impacts how we choose investments. Higher risk investments will give a better return on average. Doesn't mean that they always individually have a better return in any given year, but on average, a higher risk investment will give you a better return. So why is that? We call it the risk return trade-off. It is an essential element to the investing concept and the idea of portfolio management. And the reason that it happens is because if I'm going to take more risk, I have to be given more compensation to take that risk. The company who is selling the shares, if they want me to buy their shares and their shares are riskier than another company's shares, well, they've got to give me something to make me want to do that. So the higher return is my compensation for believing in that company and taking that higher risk. So I say on the slide that the pricing of an investment is dependent upon the return requirement to take on the risk. So we figure out when we're determining that $32 a share for company A's share value, that just doesn't just magically appear. It happens because the investing public knows how risky company A is, and they will only pay the price that will give them the return that they require for the risk that they're taking. So the price happens as a result of the risk of the company. And then I say the yields of investments will therefore increase as the risk of the investment increases. And that's because the investing public demands it. They will only pay what will provide them the risk that they, or sorry, the return that they need for the risk taken. All right, so no general discussion of investments would be complete without a discussion of the efficiency of the markets. And again, we will deal with market efficiency in detail later. This slideshow presentation is, as I've said before, just a general introduction to a lot of this stuff, and we'll deal with everything in more detail later. But I talked about in the last slide the fact that investors will only pay what a security, or sorry, the price for a security that will give them the return that they need. So efficient markets, when we talk about that $32 stock price for company A, efficient markets is this concept of, is that $32 the right price? How efficient is the market at setting that price? So in the slide, I say, due to the efficiency of the markets, you can rarely expect to find bargains. So we've got a whole lot of investors in the market who are competing with one another to purchase these investments. And we've got a lot of analysts that are doing research, and we've got investors that are doing research, and they've all determined what they feel the risk level of that company is. So they're setting that price. And most of the time, they're pretty good at setting that price. And we rarely will find that things will be under or overpriced to a large degree. If the markets were totally efficient, then we would never find a bargain. We would never find anything underpriced, and we would never find anything overpriced. But the reality is that some areas of the industry don't get paid as much attention, or sorry, of the markets don't get paid as much attention to, and maybe there will be some under or overpricing. And we have markets that are made up of people, and people often will react in irrational ways, and you'll have herd mentality. And so sometimes prices can get driven up too high or driven down too low. So this idea of how efficient the markets are takes into consideration all of that stuff. When we're managing a client's portfolio is when this active versus passive management comes in. As a portfolio manager, I can choose to believe, or I can believe that the markets are very efficient, and therefore there's really not any point in me trying to beat them by actively trading all the time, buying and selling, because the prices are pretty much what they should be anyway. So if I believe that, I'm going to be pretty passive in my investing. I'm going to buy investments that I think are good and hold them until such time as that the fortunes of that company have changed. If, however, I feel that the markets are not totally efficient, there are underpricings and overpricings, and I can take advantage of that and I can make better returns, then I'm going to be a more active manager. I'm going to buy and sell more frequently. So the EMH is the efficient market hypothesis, and when we deal with that later on in this course, we're going to talk about all of those issues. The one thing that I haven't dealt with as I've talked about this slide is this word arbitrage. Just so that you have an understanding, just a very general understanding of it. What arbitrage means is if I can buy an investment on one market and sell it in another market at a higher value, then I can have riskless profit. And that's arbitrage. So we don't just have one market for securities. All securities are not sold on the Toronto Stock Exchange. They're sold on all sorts of exchanges. So if there's a mispricing between the two exchanges that we're looking at, then we can have an arbitrage situation where we have a riskless profit situation. So just to give you an idea of what that is. All right, that finishes lesson 1.2. It's a long slideshow with a lot of information, but again, just general information to get us started.